When markets become volatile, investors are often faced with a fundamental question: should exposure be held through drawdowns, or should portfolios be actively rebalanced to manage risk? This video compares two professional approaches to managing Saudi ETF exposure within a diversified portfolio, holding through volatility versus disciplined rebalancing. This is not a recommendation and not a forecast. It is an educational comparison designed to explain how professionals evaluate these approaches based on portfolio objectives, risk tolerance, and structural constraints. To understand this comparison, it is important to begin with a core principle of professional investing: volatility is not an anomaly. It is an inherent feature of financial markets. Professional investors do not attempt to eliminate volatility. Instead, they design portfolios to function effectively in its presence. The first approach we will examine is holding through volatility. Holding through volatility assumes that short-term price movements do not invalidate the long-term role an allocation plays within a portfolio. In this framework, Saudi ETF exposure is introduced with a defined purpose, such as diversification, income characteristics, or exposure to energy-linked economic activity. Professional investors who follow this approach focus on the original rationale for holding the exposure. If that rationale remains intact, temporary underperformance does not automatically trigger action. Energy prices fluctuate, global liquidity conditions change, and investor sentiment can shift. These dynamics are expected and are not treated as signals to exit. Holding through volatility requires disciplined position sizing. Because the allocation is not expected to be adjusted frequently, it must be sized conservatively so the drawdowns remain tolerable at the portfolio level. This is a critical distinction. Professionals do not hold through volatility blindly. They hold through volatility because the position was sized appropriately from the outset. The benefit of this approach is simplicity and long-term focus. Transaction costs are minimized, exposure to structural trends is maintained, and decision-making is insulated from short-term noise. The risk of holding through volatility is that without monitoring, allocations can drift beyond their intended risk contribution. Strong performance can cause a position to grow larger than originally planned, increasing portfolio concentration. This leads us to the second professional approach: disciplined rebalancing. Rebalancing treats volatility not as something to endure, but as a mechanism for maintaining portfolio structure. In this framework, Saudi ETF exposure is managed relative to predefined allocation targets. Professional investors define acceptable allocation ranges in advance. These ranges are based on portfolio objectives, risk budgets, and correlation analysis. When Saudi ETF exposure moves outside these ranges, adjustments are made. If the allocation grows too large due to strong performance, positions may be trimmed. If the allocation falls below target due to underperformance, exposure may be reassessed. Importantly, rebalancing is not based on predictions. It is not an attempt to time the market or anticipate short-term movements in oil prices, geopolitics, or macroeconomic conditions. Rebalancing is a rules-based process designed to prevent any single exposure from dominating portfolio outcomes. The benefit of disciplined rebalancing is risk control. It enforces consistency and helps avoid emotional decision-making during periods of market stress. The risk of rebalancing is overactivity. Excessive adjustments can increase transaction costs and reduce exposure to long-term trends if applied too aggressively. Professional investors are aware of this trade-off. As a result, rebalancing is typically applied at defined intervals or when allocations move materially beyond acceptable ranges, rather than continuously. In practice, professional portfolios rarely rely exclusively on one approach. Instead, they combine elements of both holding and rebalancing. For example, an investor may hold Saudi ETF exposure through normal volatility while reserving rebalancing for situations where allocations drift meaningfully from their targets. This hybrid approach recognizes that volatility alone does not require action, but structural imbalances do. Correlation analysis plays a central role in determining when rebalancing becomes necessary. If Saudi ETFs begin moving in lockstep with other risk assets, diversification benefits may diminish. In such cases, professionals reassess whether the allocation continues to serve its intended role. Adjustments are made based on portfolio impact, not headlines. Liquidity considerations also influence decision-making. Saudi ETFs trade on U.S. exchanges and offer daily liquidity, which supports rebalancing when needed. However, professionals also recognize that liquidity conditions can change during periods of market stress. This reinforces the importance of conservative position sizing and diversification. Currency structure adds another layer to the analysis. The Saudi riyal's peg to the US dollar reduces currency volatility relative to other emerging markets. This stability can make holding through volatility more predictable, but it does not eliminate equity risk. Earnings, sector performance, and global conditions continue to influence returns. Time horizon ultimately determines which approach dominates. Long-term investors with stable capital may emphasize holding through volatility, while portfolios with tighter risk constraints may rely more heavily on rebalancing. Institutional investors, such as pension funds or endowments, often operate under explicit risk budgets that require periodic rebalancing regardless of market conditions. Private wealth portfolios may adopt more flexible frameworks, adjusting only when portfolio balance is materially affected. What unites both approaches is discipline. Professionals do not react emotionally to short-term market movements. Whether holding or rebalancing, decisions are guided by predefined rules and objectives. This comparison highlights a critical insight: managing risk is not about choosing a single strategy universally. It is about applying the appropriate framework to the specific portfolio context. Saudi ETFs, like all portfolio tools, require structure, clarity of purpose, and disciplined execution. They are not standalone bets, but components within a broader system. For American investors, the takeaway is not which approach is better, but how professionals think about risk management. Clear objectives, conservative sizing, diversification, and disciplined rebalancing form the foundation of effective portfolio construction. This framework applies not only to Saudi exposure, but to all asset allocation decisions. Markets change, conditions evolve, but discipline process remains constant. This content is provided for educational purposes only and does not constitute financial advice. For a structured guide covering Saudi market exposure, ETFs, risk management frameworks, and portfolio strategy, download the full Saudi market guide linked in the description.